Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera. Here are the stories for the day.
What the world needs now is people who see flight a little bit differently. Because seeing a better connected world isn't far in the future. We're building it now. GE, building a world that works.
The Finance Ministry on Monday struck a note of caution about the re-emergence of the twin deficit problem. It was also the first time the government explicitly spoke about the possibility of a fiscal slippage in the current financial year. So have the amber lights started flashing? What is the ground situation like? Let us find out in today's segment.
The World Bank recently cut its FY23 real GDP growth forecast for India to 7.5% from 8%, which is slightly more bullish than the Reserve Bank of India's forecast of 7.2%. S&P and the IMF have also recently cut their FY23 forecast for India. Amid these signs of slowing growth, further shocks could be in store. The Finance Ministry has warned of a twin deficit problem, with higher commodity prices and rising subsidy burden leading to an increase in both the fiscal and current account deficits. According to the ministry's latest monthly economic review, an increase in the fiscal deficit might cause the current account deficit to widen and weaken the value of the rupee. This could further aggravate external imbalances, creating the risk, which is admittedly low at this time, of a cycle of wider deficits and a weaker currency. But at the same time, the report also said that even as the world was looking at a distinct possibility of widespread stagflation, India was at low risk due to its stabilization policies.
Well, the implication for the economy is that the government would have to be willing to accept that the growth rate would be lower than targeted. It's just that so simple. Because lower the growth rate, the better would be both the problems. But if the government tries to keep up the growth rate, then both the fiscal deficit as well as the current account deficit will widen.
See, for fiscal 23, it looks like that we will be having a higher current account deficit, which is going to put pressure on the balance of payments and hence the currency. So this is something which we will not be able to escape, and the RBI will have to constantly intervene in order to steady the balance of payments. Growth is going to take place on account of what happens in the private sector. The government will only have to work to make sure that their capex targets for 22-23 are met. And it looks like that there is a bit of determination on that, and they could be looking at cutting other expenses in order to ensure that you reach the fiscal deficit number of 6.4% without compromising on growth.
Meanwhile, Indian financial markets have witnessed hefty foreign investment outflows the past 8 months. A weak GDP growth outlook has exacerbated the situation. However, a paper co-authored by Reserve Bank of India's Deputy Governor, Michael Debabrata Patra, says that there is only a 5% chance of portfolio outflows of up to 3.2% of GDP in a year in response to a COVID-type contraction in growth. In a black swan event comprising a combination of shocks, there is a 5% chance of outflows under portfolio investments of 7.7% of GDP and short-term trade credit retrenchment of 3.9% of GDP. The warning about a twin deficit begs the question, will the government have to prioritize macroeconomic stability over near-term growth going ahead?
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं? ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं? वो तो सबसे आसान है. तुझे 5 पैसा नहीं पता?
अब तो सबको पता है. 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज. डाउनलोड 5 पैसा नाउ.
अब तो सबको पता है. Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The Reserve Bank of India has meanwhile barred all non-bank prepaid payment instrument issuers from loading credit lines, a move which will impact fintech players. Of late, the central bank has been coming down heavily on fintechs. RBI's 2025 vision document talks about the need to regulate fintechs in the payment space. So what is the road ahead for the fintech firms? Let us find out in our next segment.
In a move that could have huge ramifications for India's fledgling buy now pay later or BNPL market, the RBI has asked non-bank prepaid payment instrument or PPI issuers to not load these instruments through credit lines. Issued in the form of wallets or prepaid cards, PPIs facilitate purchases against the value stored on them. They can be loaded by cash, debit to a bank account, debit and credit cards. Fintechs in the pay later card business like Slice, Uni, LazyPay, PostPay, etc. make use of bank-issued PPIs and partner with NBFCs to offer credit lines to customers. According to RBI, there are 37 non-bank PPI issuers, including Amazon Pay, Ola Financial Services, and Bajaj Finance, which is one of the biggest NBFCs. RBI's move has given rise to some confusion, even as the industry is still evaluating the impact of its clarification. Macquarie Capital said it could impact credit card challengers who were adding lakhs of customers every month. PPI is meant to act as a payment instrument and not a credit instrument, it said, adding that many customers were also unknowingly taking a line of credit through their wallets at the point of checkout, and some of these practices may not have gone down well with RBI. But given that RBI's letter is addressed to non-bank PPI issuers, Nomura analysts believe there will not be any restrictions on such pay later players unless a similar letter was also sent to bank issuers. Fintech startup Red Carpet's founder Sandeep Srinivasa said that all BNPL products in India work on PPIs and the fintech lending ecosystem works on the principle of credit lines through wallets and built on top of PPIs.
Yes, this is going to be impacting everyone who is in the BNPL space. The cost-free EMI, PPI leveraged business models around retail payments, everything is getting impacted. When the RBI says non-banks are not allowed to top up prepaid instruments directly from a credit, it's not yet clear whether the banks are allowed to do that, right? They haven't said banks are allowed to do that. My reading is banks are allowed to do it. Having said that, it is nothing new. This has started quite some time back with RBI's working paper on digital lending, and then the KYC and compliance related concerns also. Now, even with NBFC, peer-to-peer lending, whichever other form of licensed lending business that they can do, PPI suddenly is taken out, which means the experience is going to be impacted. Without PPI, how do you load? You will have to process it like a loan and then push it to customer's bank account. Instant credit on need basis is kind of taken a hit. So it's a clear shock and heavy impact, I would say. It is understood that we can't now start building a business model keeping PPI in the middle.
Macquarie said that risks are increasing for the fintech sector, for which regulations have been light touched so far. RBI's Payments Vision 2025 states that a discussion paper on the need for proportionate regulation for them, encompassing domestic incorporation, reporting, data use, etc., will be published. It also talks about looking at the various charges for payments in such a way that it further encourages digital adoption.
Whether it is for fintechs, NBFC or banks, it's not an acceptable arbitrage to have in a system. This is, as a regulator, as a central banker, it is going to be their continued pursuit to ensure that those arbitrages are addressed if they're giving systemically wide gap for someone to play foul. More importantly, RBI is already regulating fintechs. Data localization rules are there. Fintechs are supposed to be following all the guidelines as far as KYC is concerned, even the source of funds is concerned. So the outsourcing guidelines are there from RBI in terms of how a fintech can work with a bank. There's enough working papers. So RBI is already regulating them directly, indirectly.
With RBI not keen on the idea of issuing licenses for digital-only banks, Grant Thornton Bharat's partner Jay Krishnan G said that neobanks and fintechs are under pressure to reinvent their business models as they were hoping to eventually transform into open or digital banks.
यार
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After the fintech firms, let us move on to telcos. Shares of Vodafone Idea and Bharti Airtel have mostly been in the red for quite some time now. Despite news flow around 5G auction and the digital transformation, the shares have not generated expected returns. Our next report delves into the issues denting the sector and how investors can play the theme.
Despite an ongoing recovery in the telecom sector, analysts believe the stock performance of Vodafone Idea and Bharti Airtel may remain sluggish in the near term. Their shares have cracked around 8 to 14% in the past 3 months as the benchmark Nifty 50 shed 7.5%. Going forward, likely heavy investment in the upcoming 5G auction coupled with flat subscriber growth may act as overhangs in the near term. Telecom Regulatory Authority of India's data showed that industry-wide active subscriber base dipped by 7.8 million month-on-month in April 2022. While Bharti Airtel lost 3.1 million customers, Reliance Jio lost 0.1 million and Vodafone Idea 3.8 million. Meanwhile, the industry-wide mobile broadband subscribers remained flat at 760 million. Analysts at JM Financial feel the broad-based active subscriber decline suggests that the November 2021 tariff hike-led SIM consolidation is not over yet. The other near-term hiccup in terms of higher than preferred spectrum prices may result in excessive capital outgo.
The biggest chaos was around the fact that the government decided to proceed with the recommended reserve price, which is 40% lower than what was initially proposed in 2018. However, industry participants have been insistent on the fact that the discount needed to be much steeper and much deeper at approximately 90% for it to be commercially feasible for the participants. So the differential is going to exert some pressure on the cash flows. That's point number one. The second point that has been hurting sentiments a lot, not just industry participant sentiments but also investor sentiments, is the accommodation of captive non-public network players and allowing them access to spectrum through direct requisitions that can be applied to the DOT. The impact is majorly twofold. Number one, this can be expected to eat into the prospective revenues that the telcos were expecting to generate from the 5G rollout from the enterprise segment of the market very specifically. So there could be some revenue erosion there. Alongside, there is also another looming challenge wherein portfolio investors seeking exposure to technology, to the 5G technology play, such CNPNs allow them a backdoor entry into such a technology, into investing into such a technology, which makes the fundraising activity and investability of telecom companies slightly more lackluster in the eyes of portfolio investors.
Pricing concern, the nascent 5G ecosystem and evolving use cases could also make 5G rollout granular.
I think two players, so there will not be a big bet. No, except for the metro cities where the connectivity is very good, like Mumbai, Chennai, South and Western India will have a very good bidding. But other part of India, I have my doubt.
Rating agency ICRA pegs capital outlay of around 1 to 1.1 trillion rupees. Of this, the upfront payment will be 10,000 crore rupees if telcos opt for a 30-year payment plan. However, debt levels could increase with addition of deferred payment liabilities of this auction. That said, near-term pain points are expected to be compensated by long-term growth. ICRA expects the industry to report a growth of 10 to 12% in its operating income in FY23, which will translate into operating profit before interest and tax expansion by 15 to 18%. Industry consolidated revenues are estimated at 2.6 to 2.7 trillion rupees, with operating profit before interest and tax of around 1.2 to 1.3 trillion rupees. Meanwhile, stock-specific action and global triggers will continue to dominate Wednesday's trading session.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
A brief respite from the spell of negative cues gave the markets a reason to cheer, as Indian equities saw an upward march for the second day running on Tuesday. However, experts are seeing bad days ahead. In the Reserve Bank of India paper, writers allude to the risk of Black Swan event, saying that it may lead to outflows of 7.8 lakh crore rupees from India. So what exactly is a Black Swan event? Our next report explains.
In the Reserve Bank of India's latest bulletin, an article titled Capital Flows at Risk, India's Experience, cautioned about an event comprising a combination of shocks that might lead to portfolio outflows of about $100 billion or 7.8 trillion rupees. Authored by RBI Deputy Governor Michael Patra, along with Harendra Behera and Silu Muduli, the report called for maintaining liquid reserves to deal with the event, which is known as Black Swan. The theory of Black Swan was first floated by finance professor and former Wall Street trader Nassim Nicholas Taleb in 2001. Taleb went on to write a book on it titled The Black Swan: The Impact of the Highly Improbable. So what exactly is a Black Swan event? It is a rare and unpredictable event with potentially severe consequences. In his book, Taleb says that there are 3 attributes of the event. The first is that it is an outlier and cannot be predicted. The second is that it has an extreme impact. And the third is the human nature to try to concoct explanations once it has happened. It can be characterized by a combination of all adverse shocks experienced in the history coming together, leading to a perfect storm. So what are some of the recent examples of Black Swan events? In hindsight, the global financial crisis could be termed a Black Swan event, as a sudden collapse of the US housing market led to a severe global economic crisis. The 9/11 terrorist attacks and the burst of the dot-com bubble in the 1990s are some of the other examples of Black Swan events. In the context of capital flows, the RBI report says that capital outflows, particularly portfolio flows, are driven by global risk aversion, and they are sensitive to shifts in risk sentiment globally. So, if there is an adverse event like COVID-like contraction in real GDP growth or global financial crisis type decline in interest rate differentials, India could see capital outflows to the tune of 3.2% of GDP or approximately $100 billion.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Till 1697, Europeans believed that all swans were white, but a chance discovery of black swan in Australia made them believe otherwise. So the metaphor of black swan, which alludes to a rarity, came from it. That's all for today. For more news and analysis, log on to businessstandard.com. We'll be back tomorrow with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.